Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for this Friday morning, the 23rd of June. If you're in Hong Kong, mainland China or Taiwan, I hope you enjoyed the Dragon Boat Festival yesterday. You can find us on Apple Podcasts, Google Podcasts and Spotify, and thank you for making us one of the top 10 most listened to financial podcasts in Hong Kong on Apple Podcasts. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, the Bank of England has raised interest rates by a larger than expected 50 basis points to 5%. That's the highest level for 15 years. A majority of economists had expected a 25 basis point increase. That was the 13th consecutive rate rise by the UK Central Bank. And interest rates surprised elsewhere in Europe Thursday. The Swiss National Bank raised its main policy rate by 25 basis points to 1.75%, its fifth consecutive hike, and it didn't rule out additional increases. Norway's central bank raised its key rate by 50 basis points from 3.25% to a 15-year high of 3.75% and said it could raise rates again in August. Turkey's central bank brought its low-rate era to a close with a 6.5 percentage point interest rate rise. The central bank lifted its benchmark one-week repo rate to 15% from 8.5%, but the rate hike was below expectations, as economists had been forecasting a rise to 20% to tame inflation running at nearly 40%. US Federal Reserve Chairman Jerome Powell warned that interest rates will need to rise further in the US to bring inflation back to target. In his semi-annual testimony before the House of Representatives Financial Services Committee and the Senate's Banking Committee, Mr. Powell said the tightening campaign still had a long way to go before the economy slowed sufficiently to bring inflation back to the 2% target. He said that the central bank could opt for 2 more quarter points rate increases by the end of the year. And President Joe Biden welcomed India's Prime Minister Narendra Modi to the White House on Thursday for a state visit, during which the US and Indian leaders announced defence and technology deals. In a press conference after their meeting, Mr. Biden told reporters that the partnership between the US and India was stronger, closer and more dynamic than any time in history. Mr. Modi spoke of a new chapter in the strategic relationship between the two countries. On today's programme, I'm joined by Francis Lun, the CEO of GEO Securities, and Alvin Chua, CIO Noir International Wealth Management. With a view from Australia is Toby Lawson, the CEO of Statton Partners. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com, where you'll find also my daily newsletter, which contains more business and financial news from around Asia.
Peter Lewis's Money Talk.
On Wall Street Thursday, the Nasdaq Composite and the S&P 500 snapped 3-day losing streaks as investors resumed buying tech stocks. The S&P 500 rose 0.4% to 4,382. The tech-heavy Nasdaq Composite Index rallied 1% to 13,630. Both indices closed near session highs. The Nasdaq's gains were predominantly led by just 5 stocks: Amazon, Microsoft, Apple, Meta and Tesla. Meanwhile, the Dow was almost unchanged, falling just 5 points to 33,947. And with the quarter reaching an end, the S&P 500 is on track for a 3-month gain of 6.6%, while the Nasdaq is up 11.5% for the quarter so far. US government bonds came under selling pressure on Thursday, as Jerome Powell warned interest rates will need to rise further. The 2-year Treasury yield rose 9 basis points to 4.79%. That's its highest point since early March. The 10-year yield rose 7 basis points to 3.8%. And that means short-term US government borrowing costs have exceeded their long-term equivalents by the widest margin in 3 months yesterday. And the gap is fast approaching the 42-year record hit during the regional banking crisis in March. The difference between 2-year and 10-year yields hit minus 99 basis points Thursday. In the currency markets, the Japanese yen slid to its weakest against the dollar since November on diverging interest rate policies between the US and Japan. The yen dropped 1% to 143.13 per dollar, and the Japanese currency has slid over 9% against the dollar this year, the second worst performer amongst its developed market peers. In Japan, the Nikkei 225 gave up early gains, falling 0.9%. For the second quarter so far, the Nikkei 225 is Asia's best performing market, rising 18.6%. Markets in Hong Kong, mainland China and Taiwan were closed for a holiday Thursday, and in mainland China and Taiwan they remain closed today. Chinese markets have been global underperformers in Q2. The Hang Seng is down 5.8% quarter to date, while the tech index is off 7.9%. On the mainland, the Shanghai Composite is down 2.3% for the quarter. In Shenzhen, the tech-heavy Chinex has lost 7.8%. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our Friday morning guests, and with us we have our regular Friday commentator, Francis Lund, the CEO of Securities. Morning to you, Francis.
Good morning.
And we welcome for the first time to Money Talk, Alvin Chua, who is the CIO of Noir International Wealth Management. Welcome, Alvin.
Good morning, Peter.
Let's start with some of these surprise rate increases. First of all, the Bank of England. They've raised interest rates by a larger than expected 50 basis points to 5%. That's the highest level for 15 years. The majority of economists had expected a 25 basis point increase, and that was the 13th consecutive rate rise by the UK Central Bank. Raising the interest rate to 5% has already increased borrowing costs to a higher level than the Bank of England suggested would be the peak rate in its May forecast. And market expectations are that interest rates will climb to a peak of about 6% by the end of the year. Let me ask you both. This seems to me to be a living example of what happens if a central bank doesn't act forcefully and quickly enough at the first signs of inflation. The Bank of England, it's been quite meek, hasn't it, in its policy response, and as a result, it's now behind the curve. Inflation in the UK is soaring. Francis, what do you think? Is this a warning to other central banks?
Yeah, I think the central banks are playing catch up, but the problem is I don't think global interest rates are going to fall to something like the target 2% level. That's really too optimistic. I think some of the increases are structural that cannot be tamed just by raising interest rate. I think the central bank could be served better by just living with a higher interest rate, say 3 or 4%, because it's difficult, almost impossible to make it fall to 2% unless you raise interest rate to 10%, which will destroy the economy.
Okay, let me just add to that, right? The inflation in United Kingdom is rather stubborn, unlike, say, in America or, say, like in China or Japan, right? Mm-hmm. As such, right, there's from one side, but from one perspective, yes, the Bank of England had to raise rate, and there's more to go. However, post-pandemic, right, looks like monetary policy is left to do the heavy lifting. A lot of this, as Francis mentioned, a lot of this structural inflation problem cannot be solved by monetary policy alone. Yes, you can do that purely with monetary policy. At what economic cost do you want to bear? Right? Mm-hmm. Now, if you want to induce a severe recession, yes, of course, inflation is going to go down to zero. But is that what monetary policy is supposed to do? And I think now the last 24 hours, and maybe the last week as well, right? Global central bank, a few months ago, we thought they had moved away from aggressive rate hikes. They are back. And there will be severe consequences, both for the financial market as well as the global economy. Mm-hmm. Remember, the Fed raised rates last year aggressively. And by March this year, what we got? We get SVB imploded. We got Signature Bank. And then eventually, First Republic. Right? Mm. Now, I think the Eurozone banking system is not really stronger than the American banking system. And with this kind of aggressive rate hikes, accidents going to happen.
Well, I want to get on in a moment to what the consequences could be for the financial markets. I mean, you mentioned, Francis, that they're not going to get back to their targets. They've got to live with inflation that's going to be higher. But this means, like in the case of the Fed, for example, and other central banks, there's got to be a discussion, hasn't there, about raising these targets? Because from what you're saying, 2% is unrealistic.
Definitely. I think if you analyze the CPI components, I think one of the really stubborn number is really rent. Rents are not going down because the supply isn't enough to bring the rents down, because you have immigration pressure. There's an inflow of people coming into America. So how can you bring the rents down? Mm-hmm. And of course you can bring the gasoline down and then food prices down. But then there's some other components. I don't think you can do it. So it's actually, it is better for the Fed just to live with, say, something like 3% inflation and let the interest rate stay as it is before going to 5 or 6% and then bring in recession. That would be much worse than doing nothing.
Yeah, I absolutely agree with what Francis just said. Right, mm-hmm. The Fed's target of 2% inflation basically is the core CPI or the purchasing power. Right, mm-hmm. Now, 2% is not legislated. It's not cast in stone. It's not in the Bible. 2% is what the Fed just decided arbitrarily. The average inflation rate for the past 15 years seems to be about 2%. So why 2%? Why not 2.5%? Why not 3%? Right? And perhaps the Fed should be able to tolerate a little bit higher, say 2.5% or 3%. Right? Yes. The largest contribution to the inflation in America is a component we call rental equivalent, which is sort of like arbitrarily, right? Rental equivalent. Well, I mean, it's a supply problem. It's not interest rate sensitive, right? Whatever interest rate it is, people got to rent. They have to rent. No, basically, it is what it is, right? So I think my belief is that maybe the Fed paused last week, right? Oh, I should not use the word pause. No, Jerome Powell
doesn't like that word.
Doesn't like that. He said, "Well, they just skip for a meeting." So possibly the Fed may hike rate, later part of next month, and then they will stop for a few months, and then the market is pricing in the Fed supposed to cut rates aggressively going into 2024. Okay, fine, whatever it is. Another 25 basis point rate hike in America is not going to kill the economy. But I'm more worried about what's going on in the rest of the world. Right? Mm-hmm. We have significant monetary policy divergence. America, I think they will pause now. And Europe is back on the hiking trail. Here in Asia, Japan is on a very low interest rate. China is aggressively lowering interest rate by any means possible. So with these monetary policy divergence, we're going to get into economic growth divergence. We're going to get into currency divergence. We're going to get into investment return divergence. So where do we put my money?
Okay. I'm going to ask you in a moment.
This is the Peter Lewis money show.
Yeah, I'm going to ask you that in a moment. Then let me just ask you about Asia. I mean, these four central banks in Europe. I count Turkey as being European as well. It's sort of European, isn't it? But all four of them surprised investors in one way or the other. But here in Asia, it seems central banks are more in control of inflation, doesn't it? I mean, if you look at just yesterday, we had Indonesia and the Philippines, both left rates unchanged, but inflation seems to be coming down there. Why is it that Asia seems to be on top of the problem, Europe seems to be behind the curve, and the US is still struggling with inflation?
Well, I think basically because there are two big components in Asia's CPI. One is energy costs, and the other is food costs. And food costs and energy costs are rather stable during 2023. So you have basically weak inflation, and then on top of that, you have weak demand in the two biggest economies in Japan and China. China's economic recovery is running out of gas.
And there's no inflation in China, is there? In fact, deflation at the factory gate level.
Yeah, that's right. And then what happened? What happened has been because aggressive interest rate hike, demand for exports from Asia actually declined. you have factory shutdowns in Asia, so that which led indirectly or directly to weak demand because the factories are not running at full speed and people are not buying, people are not earning enough money. So with no money, of course, you have deflation instead of inflation.
Well, in Asia, we have a very different economy. Japan is considered developed economy, and Japan been struggling with low inflation or for many years deflationary pressure. Right? Now, the rest of Asia, say Asia, the Pacific area, like ASEAN countries. Now, the supply problem that's crippling Europe now does not happen in the ASEAN countries. Supply, basic necessity is fine. China is a different story. China is excess supply and there's no demand. Right? Consumer are not spending. Consumer not spending because the job is not as secure as it used to be. Right? College, graduates, something like 20%, 25% are unable to find jobs. So they had to go home and get the parents to help out. Right? Now, the government sectors are cutting paycheck, cutting wages. Right? The private sectors are cutting headcount. So if you live under that kind of environment, you don't feel confident about to spend money. So they goes with the slack in China, so to speak. Right.
Well, let's get on to the question that you asked about what is the implications for the financial markets, because there's been a lot of movements overnight in various asset classes. I suppose the market that's showing the most pressure from these central bank rises is the bond markets. The treasuries are coming under pressure again. The 2-year treasury yield, it's now at its highest since March, and the yield curve inversion, which is the difference between 2-year and 10-year yields, which should be positive, is actually minus 99 basis points, coming up to a record once again. And Francis, we've seen this inversion now for over a year. Everyone's been shouting it means a recession, but no sign of a recession yet. So what does this mean?
Well, I think the economists and the Federal Reserve got it wrong. I think people are pessimistic about the short term. So that is why you have a very high short-term interest rate. You have a 2-year interest rate about 1% higher than 10 years, something like that. And it's basically a vote of no confidence in the Federal Reserve or in the economy. So that is something it's not easy to resolve, let's say.
I should add that the yield curve inversion indicator as an indicator for future recession is outdated. It was. I have looked into the data for many years, and I've been in the frontline market for many years. Right, before the mid 1980s, it was very correct, very accurate. When you look at a 2-year, 10-year, 3-month, 10-year, whenever it invert, recession inevitably will follow. Now, post-mid 1980s is not correct anymore, particularly going to the 90s and 2000s. Right, the indicator fails us. Right, recession is always 3 months away, and then 3 months away, and then 3 months away. Right, we heard about recession, yield curve inversion since July last year, and recession is imminent. And by now, Janet Yellen has said just overnight that the recession risk in America has actually diminished. Right. So where is the recession? So I think we can no longer look at the yield curve inversion.
Is there an addition we should add to that rule, though? Because what people have been looking at in the studies now is saying it's no longer enough for it to be inverted. What happens is it needs to sort of come out of the inversion, and then that's a much more positive sign of a recession.
So what's going to happen if we have a sustained period of yield curve inversion? Accidents happen, right? So banking systems will, invariably, every bank will take deposits, basically borrow short term, and invest or lend money on a 3 to 5 year duration average. With the significant yield curve inversion, you cause the bank to be bleeding when your borrowing costs exceeded your lending or investment return. That's tragic. And at the end of last year, or Q3 2022, the entire U.S. banking system was sitting on $700 billion of unrealized loss. Bank of America alone was 100 billion out of 700 billion. By the end of Q1 this year, the number have decreased to a little bit over 500 billion. But bear in mind, the 500 billion number, almost 180 billion decrease, represent 3 banks which mark to market, i.e. SVB, Signature Bank, and First Republic. So for the rest of the banks, they're still sitting in enormous unrealized loss. And if the Fed were to increase rates further, or if the yield curve remain inverted for a sustainable period of time,
it's going to be pain.
It's going to be pain. And I can imagine this pain is going to spread to Europe. You look at European interest rate, Eurozone interest rate, coming off last year, it was 8 years of negative interest rate. So from transitioning from 8 years of negative interest rate to now 3.5 and possibly quite likely 3.75 pretty soon and perhaps higher, it's going to inflict significant pain on the banking system balance sheet.
And what about the currencies? Obviously, as long as rates are going up and yields are going up, the US dollar is going to carry on going up, isn't it, as well? The two currencies that seem to be taking it on the chin the most, the Japanese yen, which is at a 7-month low now, and the Chinese yuan, which is at a 6-month low. Those seem to be the two currencies that are being hit most of all, don't they, Francis?
Yeah, definitely. And that is why you have imported inflation, but still people don't seem to mind imported inflation. But the problem is when the renminbi is low and you have less money to spend going overseas, that will dampen outward travel. So with the economy in a weak state, China cannot afford to raise interest rate. China will have to cut interest rate further. But really, cutting interest rate won't help the economy right now, because what you have is a weak demand and poor employment situation. Unless the employment situation improves, you are going to have the pressure on lower interest rates.
For the most part of 2022, every global currency versus the US dollar basically devaluating versus US dollar until early November last year. Now, the devaluation was driven by aggressive US rate hikes. Right? And by early November, the market expectation is that rate hike is coming towards the end. Is no longer going to be aggressive. So the world currency recover. What you just mentioned, Peter, the two major currencies, yen. Yen had devalued significantly last year versus US dollar and recover for the first half of this year until recently due to the expectation that US rate hike is coming to an end. Now, the Chinese renminbi is totally different story. With the state of the economy right now, with the export significant slowing in China exports, right? And with the unemployment situation, with the wages situation, with confidence, I think we can reasonably expect that the Chinese currency will remain weak versus dollar for a period of time.
Yeah, okay. And what about US stocks? They've been behaving as if nothing's happening, basically, haven't they? I mean, if you look at the quarter so far, the S&P 500, it's up 6.6% so far. The NASDAQ up 11.5% so far. But I should make one big caveat. There are now 7 stocks which are accounting for the whole of that rise this year, and they make up about 25% now of the S&P 500. So what do you make of this rather odd US equity market performance that we've seen so far, defying rate rises and all the problems in the banking system and elsewhere?
Yeah, what you have is the Magnificent Seven. That is really big tech stories like Apple, Microsoft, and NVIDIA, and now AMD. Because AI is opening a new growth area for technology and also for the stocks. So what you have is a really very uneven rally. You have the Dow Jones not rising much, but then you have Nasdaq rising really very sharply, making for lost ground in the first quarter. So I think sooner or later you will reach a level that the big tech stocks are really too overvalued, and then you will suffer a crash sooner or later.
There is significant industry divergence in America, as Peter you just pointed out. The Dow Jones, as of yesterday, only up 2.41% year to date. Now the S&P is somewhere in between, 14.13%, whereas the Nasdaq is up like 30%. Now, if you take the Nasdaq is over 3,000 components. If you take the Nasdaq 100, top 100 stocks in the Nasdaq, called Nasdaq 100 Index, NDX, is up 37%. Now, then you take it one step further. You look at, say, like the FANG Plus Index, a 10 stocks index, right? It's up 73%. And of course, the ultimate, if you're fortunate enough to have the foresight to invest in NVIDIA, it's up 194% year to date.
Right? So just buy one stock, really. That's all you need to do.
We cannot buy one stock. We have to be, I wrote an article last weekend, right? None of us can outrun a high-speed train. But in the investment world, we do not need to outrun the high-speed train. We just need to get on the train. Right? Yeah. If you are on the train and the train is going at 200 miles an hour, you are moving forward at 200 miles an hour. Now, the world have changed. Who is not talking about AI? Who is not talking about ChatGPT? Now, the NVIDIA, the H100 chip, is $40,000 a chip. And corporates who want to build the AI infrastructure, basically you have to sink in $250 million to have an AI infrastructure. And I'm thinking like tens and hundreds of corporates are doing that, building their AI infrastructure. So now the AI will not be, the NVIDIA chips will not be sensitive to interest rate. Will not be sensitive to inflation. Will not be sensitive to the upcoming U.S. election next year. Will not be sensitive to geopolitical pressure. Right? Basically, you have to be on the train. Just like 25 years ago, if you ignore internet 25 years ago, you are ignoring at your own peril.
But as well as being on the train, though, you also have to know when to get off the train, don't you? That's because, as we found back in 2000, if you stayed on the train for too long, you then suffered some rather heavy losses. So what is the risk of the same thing happening again, that these AI stocks eventually, as good as they are and as insulated as they are from global problems, it all runs out of steam, and as Francis just said, you're caught up in the train wreck?
I think we are early part of the train journey. Right?
Okay, so it's safe to stay on the train.
2000 was kind of towards the 1999 and early part of 2000. It was parabolic. We have not seen the parabolic rally yet. Now, as much as 100...
Even when Nvidia's up 90%?
194% is salivating. Now, in early 2000, we are talking about 2,000, 3,000%. Okay, when we get to that stage, remember to get off the train.
Okay. Well, let me ask you about markets out here then. I mean, the star performer has been the Nikkei 225. It's Asia's best markets, risen almost 18.6% so far this quarter. Francis, Japan's sort of sucking money out of everywhere else, isn't it? Particularly China, I think.
Yeah, definitely. I think, but don't forget, Japan has been in a slump for the past 30 years.
Yes. Do you know, I moved out to Japan on December the 30th, 1989, which was the very peak of the Nikkei 225. So if ever I come and say I'm coming out to your area, just be very afraid.
So it's a really long overdue rally.
I've waited a long time.
Yeah, but when you have to wait 30 years for recovery, then you really suffer a lot. I think the fear is that Chinese stocks will suffer the same fate as Japan, because it has been in the doldrums since 2015, and now it's already 8 years. So I don't know how long that slump will last. And if the Chinese stock market is slumping like that, that does not bode well for the Hong Kong market.
It's what it means to be a long-term investor, doesn't it, in Japan?
It means your investment won't appreciate in value.
Peter, you chose such an auspicious day to move to Japan.
I didn't know it at the time.
December 29, 1989, coincidentally, was the historic peak of Nikkei 225.
Yeah, that's right.
38,957.44. And we've never seen it again. Even right now.
I've given up hope of ever seeing it again.
It has been 33 and a half years.
Yeah.
There are not that many 33 and a half years in my lifetime. There are not that many 33 and a half years for our time to invest and earn a return. And as a professional investor, you have to think about the return expectation, the cost of capital, right? Money, investments, global investment have a choice. You invest where you can earn a return, right? And now, individually, we can take a longer term perspective. We don't have a daily, weekly, monthly peer group comparison, but which is exactly what happened in China right now. Right? If you manage money, EM money, and you are based in New York, you are based in London, you overweight China, your performance is going to be in the bottom 5. And if your performance in the bottom 5, it's time to look for a job.
You'll be out of business.
Your career, it's a career-threatening investment style. Right?
So what's gone wrong for Chinese markets then? I mean, they have been the global underperformers this quarter. The Hang Seng down 5.8%. The tech index even worse, almost 8%. The Shanghai Composite down 2.3%. But then in Shenzhen, the Chinex down almost 8%. What's gone wrong?
You don't have to look any further than the two big tech stocks, Tencent and Alibaba. In 2020, November, the government discovered that these big techs are going to be, they have gone to too big. They have too much money. They have more money than the government, and they have more influence than the government. They're into everything. They use the money to buy everything, so that they have a crackdown on these big tech stocks and force them to sell off many things and force them to modify their monopolistic methods, and of course force them to downscale, and then they are not hiring, they're firing people, and everything, all the economic woes can follow from that action. So I think if you want to really help the economy, I think you have to reverse the crackdown on big tech.
I dissect the Chinese equity market, right? Now, if you look at MSCI China year to date yesterday was down 4.5%. Then you look at Hang Seng Index year to date yesterday or the day before holiday was down 2.85. And then look at the Shanghai Index, the Asia Index, was up 3.5%. Now, the MSCI China basically is about 40% component is the Hang Seng Index, 40% component will be like the U.S. listed Chinese companies, and 20% the Asians. Now, the investors who participated in the MSCI China Index or the Hang Seng Index are heavily overweight towards global investors. And global investors, by definition, are professional investors. And we have a concept called value trap. You think the equity, the stock is cheap. The cheap may mean it remains cheap. That means you're not going to earn a return. So if that is the expectation, you get out. And you wait until the turning point comes or until the inflection point comes. And we are waiting. I'm waiting for the inflection point. I don't have a time frame.
Okay, well, it's great to hear your thoughts. Thank you very much for coming in this morning. That's Alvin Chua, who is the CIO of Noir International Wealth Management, and our regular Friday commentator, Francis Lun, who is the CEO of Securities.
Peter Lewis's Money Talk.
I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Australia. Morning, Toby.
Good morning, Peter.
Let's start it in Australia. We had the Reserve Bank of Australia's minutes of its last meeting where it surprisingly increased interest rates. I suppose the main highlight of that was it said that inflation data has shifted to the upside. It seems to be that we're getting a few central bank and inflation shocks at the moment.
Yeah, it's an interesting debate right now, and we can talk about all around the world, but particularly here in Australia. I think if you looked at the minutes of the Reserve Bank Board meeting of the previous meeting held when they kept rates on hold, they were pretty confident that they might have seen the peak in the cycle. And then subsequent to that, they saw a pickup in housing. They saw the data not necessarily showing the level of decline in consumer spending that they would have expected, maybe the lag not coming through. So they sort of pivoted a little bit back the other way. And this is consistent with what we're seeing around the world. So I think the concern for all central banks is the idea that beating inflation is one which requires consistency and aggression, and a sense that maybe they've started to potentially lift the foot off the pedal a bit early. And in Australia, that was pretty much a similar case. And one of the interesting factors that came through in the discussion with the Reserve Bank was the change in view on employment. Because one of the surprises, I guess, around the world is the tightness of labour markets, despite the increases in interest rates that we're seeing. And it was interesting, and I'm not sure people are too interested in the technical elements of economics, but the non-accelerating inflation rate of unemployment, the NAIRU, which is a measure that's used. The Reserve Bank in Australia recently changed this to 4.5% from 3.5%. So effectively saying that with unemployment so low, there is more room to move on rates before you get to a neutral state of unemployment. So another, 2 rate hikes or more isn't necessarily going to impact the unemployment as much as people think.
It sort of becomes a self-reinforcing spiral, doesn't it? Because if inflation goes up, workers demand higher wages, which in turn embeds inflation even more into the system.
Yeah, and the only way that you can absorb higher costs in relation to labour force without having the huge inflationary effect is by increasing productivity. And productivity is actually declining in some parts in Australia, and actually is a real challenge for the government in order to lift productivity, because wages, increasing unit cost of labour, can only be mitigated by increases in productivity to reduce the total unit labour cost and therefore be disinflationary. So that's the issue right now, is that, wages are going up, albeit not at a huge rate, but we're not getting the productivity lift that can actually absorb some of that increase. And that's really the concern, I guess, in the deeper thinking of the Reserve Bank.
How much is public pressure playing a part here? Because I think the general public has started to realise, haven't they, over the last year, what inflation really means. And they are learning, and have learnt the hard way, that it's a tax on their incomes, and quite a big tax on their incomes. So is there public disquiet in Australia? Because there certainly is in some other parts of the world about what the central banks are doing and how inflation has got out of control.
Yeah, I think clearly there's criticism of central banks in terms of how they've reacted to inflation. It's quite a deep discussion because, central banks were caught a little bit off guard through the COVID pandemic, where they, pretty much overstimulated the economy. And this was, driven by fear and government decisions, spending lots of money, big crab, pushing interest rates towards zero. All of those things were an overshoot that at the time obviously were felt to be necessary. Like a rubber band, you pull it one way, it comes back the other way. And that's exactly what we're seeing now. And now people just need to adapt to that, see that the absolute level of interest rates is not that high historically, but actually the impact of the lower rates is actually having the inverse effect in terms of acceleration on the other side as rates go up to sort of drive down what was effectively engineered through supply chain disruption on COVID, through overstimulus of central banks and governments in that period during COVID, which sort of now needs to be tapped back out of the economy. And so clearly as rates went down sharply, they're coming back even more sharply. And this is something that people are just are not used to, that level of volatility in rates. And so as a result, you're getting a lot of criticism right now.
What do you make of the Bank of England overnight? They raised rates 50 basis points. That was more than what most people are expecting, although market expectations had been moving up rapidly after that horrible UK inflation data. Consumer price inflation, 8.7%. Economists had expected it to drop. Core inflation actually rose to 7.1%. I mean, it seems the Bank of England is really behind the curve.
Yeah, well, what's that now? Rates at 5% with a 50 basis point move. The Fed is already at 5.25, most likely to go towards maybe a terminal rate closer to 6. So yeah, they've got a ways to go in the UK, and they've got inflation that's much more persistent than what the US has got. So it would appear as if the Bank of England got a bit of a job on their hands. I thought what was most fascinating, I guess, was overnight when we're talking about all these rate hikes. Norway did 50, Switzerland, Canada this month. What about Turkey? Turkey had a policy of not raising rates, in fact, cutting rates. Now, Mr. Erdogan won recently in his election. They've gone completely about face, and they raised rates 650 basis points overnight to 15%. So there's the story on inflation for you.
It's Turkey sort of trying to return, I think, back to a more normal economic policy, isn't it? And actually, people were disappointed with that 6.5% rise because although rates went up to 15%, the majority of economists thought they should be going up to 20%. So that was a surprise on the other way.
Yeah. I agree, but that was a bizarre policy construct in Turkey. Let's be honest. But if you're looking at the overall picture now, European Union. The ECB, when they raised this month, they were quite clear and emphatic that they're not finished. So, in the last 3 months, things have turned very much to the idea that central banks feel that they need to, be much more aggressive in the language to prevent a perception that inflation can become entrenched in the economies.
It seems investors are actually, in some ways, more concerned about what Norway and Switzerland did than the Bank of England, because the Bank of England was expected to raise rates. Norway wasn't expected to raise rates by 50 basis points. Switzerland wasn't expected to raise rates at all. It seems to be suggesting that central banks are concerned that inflation still isn't under control, and it seems to be sending a signal that they can't take their foot off the pedal. Where we're going to have to expect more rate rises.
Well, the problem with inflation is that it's a perception. So once it becomes entrenched, it's almost it's very difficult to get out of the system. So monetary policy is very aggressive to avoid it becoming entrenched because, as we mentioned in the earlier part of the call, you get these spirals. If it becomes entrenched, an expectation of prices going up means wages go up, and then you have the negative feedback loop. And, those who have long history views would go back to wage price spirals of the 70s and 80s. And what happens then is interest rates have to be even more aggressively raised to try to break that cycle. And so this is the concern central banks are on top of. And I think it probably emerged, and this is an interesting observation here in Australia. We saw housing prices, which had already been lofty, had come off, but not that much, and then started to rise again. And I think this is probably something that maybe central banks are perceiving, is that the consumer and the market started to think we'd peaked, and they didn't want to have that message because they don't want it to want the economy or want they need to slow demand even more than what the perception is in the market. So. Yeah, this is quite a turnaround in attitude, I think, in the last 3 months.
Okay, well, let's turn our attention to India, a country you know well. You've lived and worked there. Prime Minister Narendra Modi is there for a US state visit. He met President Biden yesterday. He's going to be addressing Congress this evening, a joint session of Congress. President Biden said there is an unprecedented trust between the leaders of the US and India, and Prime Minister Narendra Modi hailed the new breakthrough, if you like, in relations between the two countries. How important is this US-India relationship?
Well, I think it's significant. When Modi came to Australia, he was treated like a rock star. Got rock star treatment. Obviously, there's quite a large expat community of Indians in Australia, but the Australian government really promoted his visit. And similarly for the US. This is the third state visit only in Biden's administration. And Modi's getting the rockstar treatment over there, meeting with all of the top C-suites, big decisions. And so it is critical for the US because they see India as a key player in the region to balance out against China. And not just and also to try to drive India away a little bit from Russia when it comes to the defence industry. So there's a lot of importance in this, and Modi is responding. I think India is becoming more confident in its relationship with the West. It's not just the United States that benefits, but France, Israel, UK, particularly in the defence sector, are really pushing this relationship because India represents a key player in the region.
And I presume this need to try and wean India off of relying on Russia for its defence and buying so much Russian oil is why we've seen all these defence deals announced in the last 24 hours, and also in the tech sector as well. We've got Micron committing at least $1 billion towards setting up a semiconductor packaging factories. Some of the defence companies are going to start manufacturing equipment in India. There's some significant deals going on, aren't there?
Yeah, and it's really important for the Indian government to promote the idea that it's about co-production and co-development, not just buying of Western technology, particularly in defence for one thing, but even in energy, even in information technology. This is a proper partnership where the aim of the Indian government is to get onshoring of production and development of new technologies, as opposed to just buying it from the West. So these are really significant deals and significant for India, but also a real sign that the West is looking to pivot into India as the major one, not only a major market but also a major partner as a pivot against China.
So one of the significant things was Elon Musk saying that Tesla is going to invest in India, make a significant investment in India basically as soon as possible, he was saying.
Yeah, I think they've already started to do some work in India, but that'll obviously pick up. I mean, Apple, Microsoft, Google, they're all, they're already there, particularly in the IT sector. It's very strong in India, in cities like Bangalore and developing in Hyderabad and various others. So it's certainly a well-worn path. India needs a lot of foreign capital to increase and accelerate its growth. So these are important relationships and important deals for them. But most importantly for Modi, from a political sense, is to ensure that they're not just about foreign capital coming in and buying technology, but it's also about co-production, co-development. India is very much about ensuring that it's a made in India approach, as opposed to just having foreign capital coming in.
But also, I mean, India has the power to place big orders overseas. We've just seen that, haven't we, with Indigo, the local airline there has ordered 500 Airbuses, biggest aircraft deal on record. So, there's potential, aren't there, for European, US companies here?
Well, I think the interesting thing there, that's true. And what is probably most true is that the investors outside of India don't really recognise some of the sheer scale of some of these companies that already exist. You may have heard of the Tatas and Reliance and others, but there are many, and HDFC in the financial sector. But there are many, many big companies and such a huge opportunity. And Indigo is a good airline. With potential to grow. I remarked to someone here that I never went on a plane in India, even during COVID, that wasn't full. There's a huge demand for travel in the domestic market in India.
And let me quickly ask you finally about the Indian markets. They're at record highs. The Nifty 50's reached an all-time high. The Bombay Sensex as well. Massive amount of foreign inflows, almost $9 billion now since March. Is India, that is the market to look at the moment, isn't it?
It's hot at the moment. It's certainly not cheaply priced, particularly in the top Nifty stocks by various measures. But yeah, it's clearly an economy that people are starting to take a lot more interest in. It was interesting. People tended to wrap investment in India into an emerging market portfolio. Now it's becoming maybe a more direct single country approach towards India. The deeper liquidity in the equity markets, driven by much more domestic investment in equities, helps foreigners feel more comfortable that they're not the ones driving share prices. That the domestic market is much deeper, so liquidity is good. Continued reform in markets, continued reform in regulation in the corporate sector is also a positive. So yeah, right now it's hard to be too negative about India. Always on the horizon for us, for those who've experienced India for a time, is there will be headwinds and not insignificant headwinds down the track. But right now, India is on the rise. I think it's inevitable. It will be a bit bumpier than what people think, but definitely worth keeping an eye on.
Toby, thanks very much indeed. Have a great weekend. That's Toby Lawson, the CEO of Statton Partners. Thank you very much for listening this morning and this week. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then, Alex Wong, director at Alex KY Wong Asset Management, and Hong Kong-based macro strategist Patrick Bennett. With a view from mainland China is Yanan Wu, the chairman and CEO of Surfing Group. Have a great weekend.
Money Talk